You're one of the co-founders of Life360 that took it public not only once, but twice.
I'm a co-founder, technically. I bought out the co-founder. I borrowed 2x my net worth. We were on the verge of begging people to just put in money so we can survive. Every fund on Sand Hill Road said, no, this is never going to get big. Kids are not going to have smartphones. This will never go mainstream. But now everybody wants it.
How are you managing the narrative around Life360, going into that Series A with only 2 months of cash?
We did the classic mistake that a lot of founders do when they get hordes of cash suddenly showing up at their door, which is, I always tell founders, when you genuinely feel you have a champion within a venture firm, you're on the right track, and just do whatever they say. We will make the most intros to the best VCs you will ever get from anybody on your cap table. That's our promise. We will get you funded.
Welcome to the show, everyone. Today we have Itamar Novick with us, bought the co-founder out of Life360 and took it public twice, and is now the managing partner at Recursive Ventures. Itamar, let's just jump right in. Let's pick up where you left off in that story of you buying out the co-founder of Life360. Was it 2012, 2013 when that happened?
Yeah, you nailed it.
And you made that decision. Why?
Oh, okay. That's a good one. So I was actually a VC on Sand Hill Road, and I saw Life360 early on, around 2010. And the company was not very well understood at the time. Let's just say that pretty much everybody I knew on Sand Hill Road where I was working was like, yeah, we don't know about this one. And I did all the diligence work. I was a senior associate, then working at a firm called MileIQ Ventures, which was a pretty good firm back then. I did all the diligence, and especially spent a lot of time looking at their customer acquisition and sort of activation life cycle. And what I saw was pretty crazy. This thing Life360 had crazy top of the funnel demand. Now, they had a lot of issues with the rest of the life cycle. It was activation, retaining users, and obviously it was very early in terms of monetization. There was none of it. But I saw the potential, in consumer services, online services, when you see there's a top of funnel demand, there's a there. So I started helping the company unofficially, is advising them, helping with some stuff. And then at some point, around 2012, Chris Holes, who's the kind of original CEO founder of the company, came to me and said, Itamar, we really need a VP of product. You understand everything that we're doing, is sort of for your life cycle analysis, and really need somebody like you who can help institutionalize how we think about product and take it to the next level. And at that point in time, I kind of already made the decision that I should leave venture. And that's a whole different conversation than why then I left venture, right? I kind of knew that there's no ladder up for me in venture at that point in time, and that I had to go for one big swing. Luckily, there was another, co-founder early on in the Life360 journey, and him and the CEO, Chris, did not get along, and he wanted out. His wife is a dentist, and she wanted to open a dentistry, and she was like, yeah, who cares about this startup that's going nowhere? This equity is worth nothing, basically, or not a whole lot. So I was presented with the opportunity to buy out this ex-co-founder who basically left, and I didn't think twice. It was like, okay, it's a really simple equation here. If this is going to be, if it's going to hit it out of the park, like I believe it could, because it has the potential. And if I step in, I can maybe, help solve some of the challenges in the business. Then, obviously that would be an amazing opportunity. And if it doesn't, then I've lost all of my net worth, which I put all into the company and then borrowed more to be able to buy more, right? I'll bounce back on my feet. I'm in Silicon Valley and I'm a VC, right? I'll figure it out. I'll figure out another job, and I kind of
Can I just stop you there? How did you borrow double your net worth? How did you do that?
Friends and family mostly.
Got it. So you convinced them that come on with this journey. Was it a loan and they give the upside in the shares? How did you structure that for your friends and family?
Yeah, it was a loan, just a loan.
And just whatever interest, and not, was it 7 years later when you took it public, you paid them off or something, or?
No, I actually paid them off pretty quickly. I don't want to be, I don't like being in debt unless it's a very, very low interest debt. like I have a mortgage because, it's great to have mortgage 3% rate, which is what we had, what we had back in 2021, 2022. But otherwise, if I have capital, why would I take on debt? So I paid off most of it pretty quickly.
Oh.
But anyway, so so it was a big swing. It obviously paid off because Life360 is now an $8 billion publicly traded NASDAQ company. And I kind of love when it's the right time, and obviously you got to be careful with this. I kind of love to recommend folks to sometimes swing for the fences. Like if you're in the right stage in your career, if you're in the right stage professionally, if you know that you're on solid grounds, and if something doesn't work, then fine. You'll just you'll find the next thing. You'll figure out the next thing. But you want to make a big swing that that maybe has a low probability of working out, but if it does, it will completely transform, your professional life and maybe even your personal life. Then I don't think that's a bad idea, especially if you do it kind of earlier in your career.
Is that what you look for in founders now? The ones that are making the big swing that, like, I guess, jump into what you do at Recursive now, like, how do you make those decisions on the founders that you back today?
Yeah, absolutely. I'd say two things on that. First of all, if you are trying to raise money from VCs and building a VC backable company, you are swinging for the fences, baby. Like you're playing a game where the odds are against you. We know that at the pre-seed stage, 99% of companies fail. And you're doing it for the 1% of you building a multi-billion-dollar business. And that is, by definition, swinging for the fences. But I think you're also kind of alluding to something a little bit different that I think is very important. You also have to have the right mindset of being able to swing for the fences every day for the next 10, 15 years, right? Because as you go through the life cycle, for the growth of the company, there's so many different challenges, and you gotta meet them head on. Like you gotta be really, you gotta evolve with the company to be able to go through all the way. And that's definitely one thing that I'm looking for with founders.
Well, we'll unpack it a little bit more down in the show, but I think that's something that, being someone in your position, because you have a unique position, you saw the opportunity of Life360. You created and the value ultimately in growing the business, but you had a VC mindset when making the bet to jump into that role and take that opportunity. So you have that vision of kind of recognizing what are the leading indicators that might actually turn it into an outcome. But let's go back to Life360. In those early days, you bought in you're relatively early, or low valuation when you made that decision. Maybe not as much. Like, what were the stats back then, and then what were you first focused on when you took on that risk and that liability?
I think it's probably fair to say that when I joined, I was sort of the adult supervision. I mean, Chris and Alex, who are the two founders, they were in their 20s. Chris specifically, who's a brilliant person, and I work with still today, even at Recursive Ventures. This was his first job. I mean, he did an internship over the summer in Goldman, but it's not that he's worked anywhere else. Alex Harrow, who's the other co-founder, that was like his first job straight out of college. So again, both founders are kind of inexperienced as business leaders, but obviously very, very bright and technical and product oriented, which is great. There wasn't really an exec team when I joined. I mean, we tried to hire a VP of marketing, like kind of close to the time that was hired, but that didn't work out. So it's kind of, the three of us, and there were maybe like 5 people, 7 people. We were in this like almost like an apartment kind of building. It was very small. It was very early. It was generally pre-seed seed stage. So lots to build. And when I say build, it's not just building the product. It's also building the culture. It's building, our identity, like who we are, what do we stand for? What are our values? Like what's important in this company? And there was a lot that went into that. And a lot of that is still today in Life360, the kind of big publicly traded company. So
in that journey and kind of when you really start to hit like breakout velocity, kind of walk us through what was breakout velocity for you guys? When did it happen? And what was kind of the precursor to it?
I got to say that there was never a moment where we were like, oh my gosh, this is breakout. Like, maybe when ADT invested, I'll talk about that in a bit, but like, it was a grind. It was a slog. I mean, we should talk about the fact that, at some point we were 2 months away from running out of capital, and basically every fund on Sand Hill Road said no. I still have a list of 70 of them, 70 funds. We're like, no, this is stupid. This is never going to get big. Kids are not going to have smartphones. That was one of the reasons why they said no. Tracking has bad connotations. This will never go mainstream. Privacy is going to prevail, and it's going to be like, we've had all sorts of reasons that were proven to be wrong over the years. But again, at some point, I remember I think it was Series A something, there was a point in time we were 2 months away from running out of cash, and we were like on the verge of begging people to just put in money so we can survive.
This happens a lot. Like founders in this situation, like what was your demeanor? Like when you knew you had 2 months of runway and you're in the begging state. Everyone says, oh, you got to come from a position of strength so you can negotiate and get the right terms. And like, how are you managing your demeanor? How are you managing like the narrative around Life360, going into that Series A with only 2 months of cash?
I think being in that situation with your back against the wall, that's the moment that helps define kind of the true founders who never give up, who would, like that challenge, that almost life-threatening situation that you're in. The key question there is that does that really empower you to go harder, right? And try to raise that money and try to make a dent in your business now, when, even in the face of like high probability of failure, versus basically break and say, okay, this is not working. Like what do I do? And that true grit of like seeing death in the eye again. And I've seen that several times as a founder, not just at Life360. And in some situations, I've, also lost the company. And kind of being able to deal with it and actually work harder and stronger to try to get out of it is one of the things that, helps characterize true entrepreneurs versus people who are maybe less equipped to deal with the ups and downs of startups.
It is. I always like to say, amongst like post-exit founders, when you meet another post-exit founder, you immediately know that they chewed on glass and ate shit for a long enough period of time to like deliver an outcome. Because it's just always pain all the time in most cases. So when it was, what kind of was the breakout? Like, what solved that problem? What solved the Series A problem? 2 months of cash. How'd you get out of it?
We were able to. So it was an interesting situation that we were at. We had multiple corporate investors, so like strategic investors, who were like, "Yeah, if we figure something out on funding, we're probably going to participate." We didn't know to what tune. We're just trying to raise, I think, $8 million at that time, or $7 million. But obviously the corporate VCs, the strategic investors, they didn't know how to price this. They didn't want to lead the round. So they're like, just get us a credible VC that will sign off on this thing with evaluation and terms, because we don't know how to do that. So at some point, I remember it was a crazy conversation. We called up, one of my friends was at a firm called DCM, which is sort of a leading Silicon Valley Asian, related, VC, pretty sizable. And they had a small fund called the Android Fund. That was really the investors there were very interested in mobile. A lot of them were carriers or folks who were involved in mobile from Asia. It was a relatively small fund. So basically, we convinced them to put $2 million on what ended up being a $17 million round. So they led with the $2 million and a $17 million round at the end. They were kind of the lead. They priced it, because what happened is once we got that breakthrough and we got them to agree to do the $2 million, they were pretty reluctant. And I think that $2 million investment ended up being very impactful for them. Obviously, over the years as Life360 became public, but after they came in, like all the tides changed. It was like, okay, now everybody wants it, and we ended up going out for 8 and like raising 17 at the end. So it was interesting how quickly this flipped from like, oh gosh, we're gonna potentially shut down in like 7 to 8 weeks. Like, oh wow, we have more capital than we thought we'd ever had.
How much work was it convincing that Android fund? Like, how hard was that pitch?
That wasn't the hardest. I think, funny enough, DCM at that time, the Android fight was a smaller afterthought for them. They were much more focused on the main fund. So I think part of what we were actually telling them is like, no, we got this. You don't have to worry. This is not going to suck a lot of your time. Like, this is a good bet, and we'll work with your mobile LP partners to take Life360 to Asia. And I think it's going to be very interesting for your LPs. And they're like, okay, it's a small check, it's a small bet. Let's just do it.
All right. Well, you knew what triggered their needs. Like, you knew what mattered to them, and you kind of positioned it, not just "we're awesome, please invest." You positioned it in a way that was aligned with their interest.
And to be fair, we had a champion in there. I won't start naming people. We had a champion in there who walked us through this. He was like, "Hey, here's the internal politics inside my fund. Here's what you should say, and here's what you shouldn't say." And I always tell founders, when you genuinely feel you have a champion within a venture firm, you're on the right track, and just do whatever they say. Because they know what's happening in those Monday morning meetings with all the partners, and you're not really sitting there. And sometimes you'll be shocked to hear what they're talking about, because it could be completely off from what you're thinking.
Oh yeah, having a partner or associate pitch your business in one of those meetings and just completely miss them, or people interpret the complete opposite of what you want them to. But no, I think that's a super valuable experience to share, and I think it's good for founders to realize that even when you're on the brink, you just have to keep pushing and work those connections, and just not be relentless and not give up. So you raise the A, and then money just floods in, because at least people that promised to say they would follow actually followed, which is nice. And you oversubscribed. So what was the velocity of the business thereafter? What were the key decisions after that A round? Because that's a pretty pivotal moment for, it's a lot of validation for a company to get a Series A. What were some of the key decisions that you were focused on in the business that helped ensure kind of the subsequent rounds?
Yeah, so I have to say that even after we raised that round, it was not overnight success. There are a lot, and actually there was another round that came after that with ADT, the home security company, leading a $50 million round. And these two rounds were pretty close to each other. They're like a year or two apart. So at that point, we were probably, fair to say, overfunded, right? To the point that we weren't exactly sure what to do with all this capital. And that could be a very dangerous situation to be in. And I think we made a lot of mistakes back then. We didn't make a lot of mistakes back then. It wasn't clear cut. One of the challenges with Life360 is it's basically a platform that attracts a lot of consumers, right? Families and more recently teenagers and seniors. And any platform, you have a lot of opportunities. You can build up a lot of monetizable businesses on top of all this audience that you have. And we really didn't know what was the best thing to focus on, right? And some of it is you can do the work, you can research, you can understand what the market size is, you can understand what the competitive landscape is, but it doesn't necessarily fully apply to your audience. And kind of the only way to know is really to test it, right? Check it out, figure out, is there demand? Will people pay? What would be the right product? What would be the right positioning? So I think at that time we were great at growth hacking and figuring out how to get the numbers going, and doing the very basic but very basic, here's an awesome location sharing product. What we didn't know is how to take it to the next level, to start spinning high quality products on top of that, right? We had to develop that muscle. And I don't think we had that back in 2014, 2015. So it was a combination of building the right team that really understands marketing, product design, right? And other sort of infrastructure piece, like analytics, what's working, what's not. So that was one piece. The second mind piece was really shifting the mindset, right, around quality. Because the biggest thing I feel with consumer services is you can't put something half-assed out there. The bar for consumers is just so high, right? So what happens is you have to spend a lot of time on perfecting your user experience, your technology. It's got to work well. And consumers have zero patience for bugs, for issues, for shitty experiences. They just they just don't care. Just walk away, right? And they don't even tell you why. They just like uninstall, right? So we had to make this cultural shift inside the organization to like quality first. Like, no, you're not you're not putting anything out there that you're not proud of. You're not releasing anything that you're not going to want to run and go show to your grandma and say, this is amazing. Look at what I built, right? So that was also a kind of a multi-year process. And the last thing I would say is I think we did the classic mistake that a lot of founders do when they get, hordes of cash suddenly showing up at their door, which is we overhired and we weren't focused enough on hiring A+ players. Because you want to hire fast, you want to move fast. You're like, oh, okay, this person is going to do just fine. We'll let them in, and if it doesn't work out, we'll let them go after 6 months. But let's give them a try. Let's see if this works. Or like, oh wow, we've got this team member that was amazing at the seed stage. They're a great individual contributor. They know how to hack through the thing that they're supposed to do. But now you try to integrate them into a bigger company and into a bigger system, and it doesn't really work out. So they're a great pre-seed and seed stage employee, but they're not really great at the Series A, Series B when you're scaling up and you have 100 employees, right? And we would still give them a second and third and fourth chance without understanding that it's actually both bad for them and it's bad for us because they're not really operating the stage that they operate best in, right? So kind of going through those transitions in both culture and people is, it's painful, right? So I think we did a lot of mistakes there, and that's also why we burned through a lot of that cash with some improvements, but not enough. Not enough.
And with that cash, some of the things that you guys did is you started making acquisitions. I think a little bit later, but to kind of transition to that topic, you're going through all these growing pains, which is very common. When you have that much cash come in, but you still able to raise cash, raise hundreds of millions. When did growing through acquisition or making acquisitions start to come on the radar for you guys?
Yeah, so I think at my time, and I don't think we've done acquisitions since I left. I think we've done 8 acquisitions, and it's interesting because the first 7 up until Tile, which was 2020, 2021, were really talent acquisitions. And I don't see talent acquisitions as acquisitions, like typically, how the market sees them, because we're not buying a product. We're not buying a revenue line. It wasn't a business, at least most of them. There was one exception called Couple, and there was another exception called GeoBig. But the idea was always like, oh, wow, we think this team is unbelievable. The founders, the core team members are just going to be an amazing addition to our talent, and they understand our users and what our company needs. So, I mean, honestly, like talent acquisitions are way easier than a full-on, business acquisition and integration and like all the post-acquisition activities. We were really focused, like the methodology that I developed over time with the management team was really about how do we incorporate this amazing team into our business and making sure that we've got everybody where they're supposed to be, where they're making the most impact. We are giving them sort of the right constellation to win as, folks who are joining Life360 and, honestly are like compensating them so they would be interested enough to keep bringing their A+ game into Life360. So I think doing those talent acquisitions is easier than doing a full-blown integration with them.
But I guess, what kind of spotted that? Like, were you doing partnerships with them? Were you just like monitoring them? I think you invested in at least one of them, Tile, and maybe independently of Life360. But when it came to, that first one, and, did you have a shortage in the team somewhere? What kind of went through your mind when the idea of making that first acquisition came to be?
Well, interestingly enough, we're always set on keeping in touch and kind of tracking everybody in our space. You wanted to know what's going on, right? So I would just like call up people and say, hey, what's up? Hey, what's going on with your business? How can we help? We're always trying to help other folks in the family and safety and peace of mind spaces, right? That were kind of closer to us. I was one of the first investors in Tile. This was in 2014. We ended up acquiring the business in 2021. So it shows you the kind of the longevity, like how much time we spent building a relationship with the tile folks, understanding their product and understanding how a Life360 tile integration could look like. Similarly, I was one of the first investors in Placer AI, which is a unicorn that is in deep partnership with Life360 these days. And again, we've been building a great relationship since 2015, 2016. So that was really core to actually my job at Life360 over the years, is like really building this kind of multiple relationships across corp dev and biz dev with all the companies that we could potentially either partner or acquire down the line, right? And we were systematic in getting those relationships going. It's like, okay, quarterly touch points. Hey, what's going on with your business? It could just turn into a cool, conversation about what you wrote, your last trip to Australia, right? It doesn't have to be always a business thing, but just building the relationship, building a healthy relationship, and building trust with those folks. And then some of those ended up being partnerships or even launching products together. Some of these other ones turned out to be talent acquisitions, right? It was always a mix of where's the win-win? Where's the win-win for both sides, right? And when we saw that win-win and we shared the vision about, the upside for both sides, we were bold. We would go to our board and say, look, we want to do this deal. Like, yeah, there's a million reasons why not to, but here's how we mitigate them. And here's this is the downside risk, and we understand it. And we're walking into this with our eyes wide open, but we still think we should do this. And kind of semi-related is we always had to a certain degree control of the board. There was early on in the Life360 journey, it wasn't necessarily intentional, but it just, between not having very strong lead investors to having a bunch of folks who were with us for many, many years and really believed in the vision and believed in Chris and the team, we, early on could pull off almost anything that we wanted within the realm of reason, right? And that helped us. And it's funny, I'll just tell you a story. I acquired this company couple, I think it was 2015, 2016. And the CEO founder of that company, he just left Life360. He was there for 10 years. That's the best talent acquisition that you can ever imagine. Like, this person who was acquired as CEO of a company ended up staying 10 years at Life360 leading product efforts. That's amazing, right? So that talent acquisition was, very well worth it, right? For the company.
So some advice for founders that are listening that, might be a path for them, either to buy and or sell and acquire. Like, what's the profile you look for? Like, obviously you build a relationship, you build trust, but what kind of attributes did you kind of screen for when it came to doing these acquihires?
We're always very product focused. If we didn't believe that the people that we're talking with have significant product chops, they understand what the right user experience is, they build something that they're proud of, and rightfully so. Like, this is, they built an awesome product, then we were always less excited about partnering with them, right? Because for us, we knew it was always product first. As the company scaled, we're also looking for people that could be leaders, right? That other would follow, whether it's on the technical side or on the product business side. And we also felt that if we were building this ecosystem of founders that we work with and we hire and we partner with them over time, our employees would also look at that and say, wow, this is great. Like, we're building the Life360 mafia, right? And it actually became that. It became the Life360 mafia. And there's still all those people that we work with very closely and we fund and we, and we back and we partner with. And I think that's a lot of our employees wanted to see that they're like, this is going to be this Life360 family. I'm going to be part of this.
Real quick, if you're a founder doing over $5 million in revenue and want to know what the best $100 million plus founders are doing to fuel their growth, then make sure to subscribe to our $100 million exits newsletter. Get the playbooks that are proven on how to fund, grow, and sell your business. I'll even give you a curated list of investors that want to invest in your business. It's totally free. All you have to do is click that link down below. subscribe. Do it now. I promise it's worth it. You won't regret it. You got nothing to lose. Go ahead, subscribe now. Back to the show. When it comes to, I would say, buy-side M&A, and you have these relationships, you're doing the diligence, but you bought a couple businesses, not just the talent. Like, how are you structuring these deals? Like, what are you looking at? What's kind of like the timeline from when you, not from when you meet them, but when you like kind of realize that this might be the path is an acquisition? And what's the timeline on something like that?
Yeah, I think when we were set on doing the deals, we made them happen really quickly because the uncertainty, like for us, if we know that these specific people are going to, go into these positions that we have in the company, obviously we wanted to fill those positions. And we know as founders ourselves, that kind of, complications that it brings to the other side, right? It's like, what do you tell your investors? What do you tell your employees? Like, some of them might come over post-acquisition, others might not, right? So how do you deal with that? I think actually when you have conviction, moving fast, doing it fast, and having certainty around how this thing is going to look quickly is key. If you let it linger, people are going to lose motivation. So when we were set on doing it, we just went ahead and doing it and did it. There's a huge stark difference between what I call a talent acquisition, which is basically, sunsetting whatever product this other company has and really focusing on bringing the talent over and making that talent successful, and buying a product that you actually want to integrate or, manage as a standalone product in parallel to our main product. Huge difference in post-acquisition integration, huge difference in kind of what we want to see. So I would say, in talent acquisitions, it's really about the talent. It's about where the people, the founders, the founding team that we're acquiring is just a great fit culturally. We got roles for them, roles that could be impactful. Those roles are actually a good fit for their skill set and where they want to be in their career. And we want to see a lot of that overlap happening. When it comes to product acquisition, like a business, I mean, we bought Tile at $100 million of revenue. That's a significant business, right? Then it's a whole different ballgame. You really have to understand how you're going to manage this thing. And at least, historically, what Life360 has done with Tile, which is the only sort of significant at scale business, is like, yeah, we got to have a roadmap of how this integrates into our core product. Like, if we don't understand that, down to the numbers, down to the user experience, down to who's going to do what with a lot of clarity, we shouldn't be doing this at all, like to begin with, right? Because we know that, half of the M&A deals go wrong, right? They don't work out. So you need to do everything that you can to make sure it's in the right half, not. Yeah. No. If it's a product that you want to kind of keep running standalone, like not integrate your product, we haven't really done that. I think, and I often recommend founders not to do that, because it's like, okay, you're splitting your company into two. Where's the synergies? Like, what do you know about this other business, this other product? So it could sometimes work like a completely different product line, but I do feel like there could be better opportunities for the capital if that's the case.
Yeah, I know a couple companies that got stuck in what they were doing and just try to buy their way out of the situation, and didn't have a real sound strategy, and ultimately causes either the M&A deal to go bad and or the whole company to go bad. And so it definitely happens out there where it doesn't work out to be an $8 billion IPO company.
I'd say M&A has to be bite-sized for you. Like, if you're a 20 people company and you're buying another 20 people company, beware. So that typically doesn't work.
Yeah, no, I think that's good. That's good advice. Bite size. I like that. Unless it's a full blown merger, which who knows how that? Yeah, mergers scare the crap out of me. When it comes to who's going to be in charge and all that kind of stuff, and merging of teams and whatnot. But when it comes to, all right, so you made these acquisitions like Tile, $100 million acquisition.
Well, $100 million in revenue.
Doing $100 million in revenue.
$1 million to buy the business, but yes.
Yeah. And like when it came to structuring the deal, like, how did you think about aligning incentives? So we'll move the kind of talent acquisitions aside because that sounds pretty straightforward. But for like the business buying ones? Like, are you looking at majority equity, earnouts, performance, or just straight cash? Like, how did you guys think about those kind of more the business app product acquisitions?
Yeah. So our philosophy back then, and I think what is in many ways the right philosophy for companies that are like scale up growth stage, is it really starts with the product integration. Like, what can we do with this new product, right? Where are the touch points? What are the integration points? Where does this thing move the needle? Does it move the needle on acquiring new customers? Does it move the needle on like retaining them? Are you gonna be able to increase your customers' willingness to pay? It really, I think, for us in many ways, the acquisition stems from that product integration. And then, and this is where it gets interesting, we would marry the kind of upside that we're looking for from the product integration into the outcomes for the acquired company, both the investors and the employees moving over, right? So this thing is like, yeah, I mean, obviously we see the value here, and we're going to spend some money to make sure that this thing goes through nicely and everybody's happy to get going. But a lot of the upside has to be with like, how are we going to perform against the 1, 2, 3 year integration plan, right? And the delivery of that is, it's mixed between somebody who owns it on the Life360 side and obviously the founders of the company getting acquired, right? Like, they have to deliver. And if they don't deliver, right, they're both in a bad spot. The person from the inside Life360 is probably not going to be in a super bad spot financially, or they're not going to be able to, like, I don't know if they'll have their jobs, but at least they're not going to lose a bunch of money. The folks getting acquired, if they don't deliver, then the majority of the value in the acquisition might not come through, right? So that was even in talent acquisitions, not just in product business acquisitions, that was always a North Star for us of like, yeah, well, you're going to have retention bonuses here, and it will take a year or 2 or 4 for you to fully realize the value of this thing, and you have to deliver.
No, I think it's important to have those performance structures and just align incentives when it's a company buying a company and bringing those resources in. Without that carrot, we'll call it, it can be very difficult to motivate teams after the acquisition because I got my cash money, I'm on my way. So let's talk about the IPO process. So why did you IPO in Australia? Let's start there.
So first of all, I love Australia, I love Aussies, but putting that aside for a second, we were at an interesting time in the company's journey back then. We were between $30 to $40 million of revenue, which is obviously significant, but not significant enough to IPO in the NASDAQ, which was the ultimate goal. And we were at a point in time where a couple of interesting things happened. First of all, we raised a lot of money from strategic investors. Companies like ADT and Samsung and Verizon and Allstate and American Family, and I can keep going. We had 11 strategic investors at that time. And some of them were in and around the board as observers. Some of them were, they had all sorts of, veto rights that belonged to, preferred equity holders and so on and so forth. And it became a little bit hectic, right? We started getting interest, like acquisition interest from various different parties. Some of them were competitive or potentially competitive with existing investors. And we just felt like there's some degree of freedom that we don't have in this business, right? That's like, because of some of those strategic partners, we might have been blocked from doing some of the things that we wanted to do. So that was one thing. The second thing is we're really in a position where we had multiple offers on the table. We had an offer to buy the company by a private equity firm. We had another offer to buy the company by a bigger, sort of antiquated player here in the Bay Area. And we're like, okay, so we already have, at that point in time, I think we have the $150 or $170 million of preference in our preference stack. And this is something that founders don't always think of early on in their journey, but it starts adding up. So we were kind of looking at our preference stack, like the founders, and saying, gosh, like, yeah, if this thing goes up into the right and all goes well and we sell it for $1 billion or we IPO or whatnot, great, we'll make money. But if something bad happens, and there was always a risk of like, Apple trying to maybe shut us down back then, it was, or like other types of risks to the business, which some of them actually happened later on, by the way, but we're able to mitigate. Then what happens if we do a fire sale for $100 million or 150 or $20 million? We're going to walk away after 10, 15 years with nothing because of the preference stack. So IPO is very compelling in that sense because it transforms all preferred equity to common equity. Everybody's equal. Everybody, there's no preference stack. So that's the second thing. And the third thing is, and this is not intuitive, and I don't recommend this to most companies, but we actually were up for the challenge. We were like, we think we're mature enough to operate like a public company. Like, we don't know if we have the level of predictability that you need to have, but we'll set the stage. Like, we'll explain to investors that this is high risk, high growth business, right? That we're not going to be in the green anytime soon. This will be in the red because we're investing in growth. And we're just going to be very honest with investors. And we went and we did a pre-IPO. It was a $40 million pre-IPO to start getting, crossover investors to support us in case we want to do the IPO. And it was very well received. Like, we found a few great partners. Many of them are still significant Life360 shareholders. The pre-IPO was 2018. So we're 7 years in and these guys are still holding. We're like, yeah, we get it. We understand the strategy. This is high risk. This is what, we want to do with a certain portion of our fund. And we also had a good connection. One of our early, the first angel investor in Life360 is a gentleman called James from Cortona Capital. He's from Sydney, and he was an ex-banker. He knew the entire sort of industry on the ground, and he was able to really open up a lot of those doors for us. So we actually started spending time there, and we ended up saying, yeah, this could be an interesting choice. And then we started working on the IPO itself with Credit Suisse and a few other folks, and we saw that the valuation we're going to get in this IPO that also flattens all the preferred shares is actually better than the acquisitions offers that we have. So that's the moment we decided to go all in on that option, and we made it work.
What's kind of like, so we'll skip ahead. You obviously went public on NASDAQ, and your stock is close to like 3-4x since going public last year, which is awesome. Not a lot of IPOs can say that in recent times. But for, again, choosing Australia, you made the case like there's other public markets you could have gone to. Why did you choose Australia?
Yeah. So first of all, again, we had boots on the ground in the form of existing investors who knew the market extremely well. One. Two is, at that time, and still to a certain degree today, the ASX, the Australian Stock Exchange, a little bit like the AIM, but differently. And then there's one exchange in Canada that I know does the same, was actually encouraging high growth companies to come over if they were too small for the NASDAQ, which we were. So they were really encouraging us. And we also realized that it's a small market. The ASX is a small market, but that could actually work to our favor because we could cover it very effectively with analyst coverage and like really meeting all the main fundies. That's how they call themselves down there. Pretty effectively, pretty efficiently. It's also a very concentrated market. So like, sure, in the NASDAQ, yeah, you're obviously dealing with Wall Street analysts and Wall Street investment firms, but there's a lot of global, engagement there. In the ASX, it's really very local to Sydney and Melbourne, right? So you just hop between Sydney and Melbourne and you meet everybody that you want backing you in like a week. So kind of very efficient. And that's why we felt it's a good fit for us.
Oh, good insights. And then obviously it goes public. And then you go public in the NASDAQ. Like what was kind of the moment where I think you left or you're an advisor at that point. What was kind of the decision factor that kind of said like, now we're ready? for the NASDAQ? And also given the turmoil that's happened over the last couple of years, kind of like timing and everything like that, why did you choose 2024 as the right time to go on the NASDAQ?
I mean, the company always wanted to complete a NASDAQ IPO after the ASX IPO. It was always in the cards, like always something that people thought about. But obviously, you got to get to critical scale. So with $40 million of recurring revenue, that's not really NASDAQ material yet. And I think even though some bankers were suggesting that, if you hit the $100 million mark, the $150 million mark, you're good to go on the NASDAQ, we felt that we have to have more scale in that. And, after the Tile acquisition, where we brought in another $100 million of revenue, Tile revenue, we were already at, I think it was over 250 at that time. Because we kept growing organically very effectively, and we brought Tile at least 200, if not 250, when that kind of chart to the NASDAQ IPO was that path was being charted. So, but then of course, like any IPO, it really depends on the market, right? And the 2021 IPO window, we were just too small. We just did the Tile acquisition. It wasn't ready. 2022 was when the IPO market shut down. 2023 was a no-go for anybody, right? In this whole time, Life360 was scaling. So in 2024, when we had enough scale, I think it was close to $300 million of revenue at that point, which again is much more than what the kind of the bar was for the bankers. And also the being able to continue to show maturity as a public company. I mean, in 2024, when Life360 IPO on NASDAQ, it was already public in the ASX for 5 years, already filing quarterly reports, already behaving and operating successfully as a public company, right? So kind of be able to show investors that you are operating at that level for an extended period of time, obviously was able to portray the company as a much more mature company at the time of NASDAQ IPO. And all these things came together with the timing, with the markets, and it was a green light. We were ready to go.
Were you there to ring the bell?
What?
Were you there to ring the bell?
Yeah. Front row.
How was that?
It was fun. I was shocked how well orchestrated and produced this thing is. Like they always pick one or two IPOs of the day that are like fully produced A to Z, and Life360 was one of them. I think that was the one, and we did the whole like Times Square activation thing as well. It was awesome. It was a great experience, and when I did it, I was like, this is so great, but I'll never do this again. It's like the front row, even if I back a company that goes public, they're going to have me somewhere in the back there. And this is the once in a lifetime opportunity, at least for me. I don't know a lot of founders that IPO their companies twice, but I'm sure there's a few.
No, it's going to be a pretty satisfying feeling. Well, so you've had this amazing success, this amazing run, which again, you had your fire moments where things, aren't easy. Like it sounds all up and to the right, but like these are all very tactical and tough decisions that you've made throughout the journey here. But now that you're running Recursive Ventures, and you technically been doing it for a while. It looks like you started it. It was like more angel investing that kind of turned into a fund. Was that kind of how it came to be?
No, this is interesting. So first of all, I've been investing since 2010. And I was investing the whole time I was at Life360. And some of it was actually with many of my Life360 partners. So in 2014, while I was early at Life360, I formed the first fund, Recursive Ventures 1, which was super tiny. It was $1 million fund. But most of the backers were actually folks that were Life360 investors. And a bunch of the thesis was Life360 is going to create an ecosystem with companies like Tile and companies like Zendrive and companies like Placer, which all ended up being either, acquisition targets or business partners. And that was what got me going on the current strategy that we have in Recursive Ventures for over a decade, right? Then in 2018, I formed another fund while I was at Life360, a bigger fund with syndicates. It ended up being an $8.5 million sort of vehicle, and kind of kept going, but with more capital and doubling down on winners. So I was investing the whole time, and part of the sourcing and part of the sort of the opportunity was embedded into Life360 to a certain degree, not all of it, right? There's always that little bit of motivation. And the other motivation was really, so that Life360 family, like extended family that we talked about. Like, if we know we have a star employee who's leaving Life360 and starting a company, hell yeah, we want to back them. Like, this is great. We know they have high potential and they have, a chance to succeed. So we want to be able to do that and have that legacy, right? As a company of supporting our family, right? And over time, it just grew and grew and became more successful to the point that it no longer made sense for Recursive Ventures to be, something that I do on the sidelines or something that I do part of the time to help Life360, but most of the time to, support founders. And I decided it was the right time to spin out and basically build this as an independent institutional grade fund.
And I think you're on Fund 3 now, or Fund 4?
Fund 3, correct.
Fund 3. And, with the fund now and your full focus on it, what kind of, are you still, in most cases, VC is about, relationships, backing the people but like, what's kind of been your focus and your edge, as you've stepped aside from Life360 and focusing only on Recursive?
Absolutely. So what I've done, and actually I should say that Recursive Ventures is a founder GP-led firm. So I'm the sole GP, but I have multiple folks helping me out in this fund, including Chris Holes, who's the now executive chairman of Life360, and one other person called Konstantin, who's one of the best angel investors in history that I've been working with for over 15 years. Just for the record, Konstantin is one of the first investors in Tesla before Elon. So among 20, and he has like 20 other
paid off if he held.
That in Canva. He also did Canva as a very early backer. So even though I'm the only GP, it's a team effort, and it takes a village to do what we do today at Recursive Ventures. But what I would say is we've done extremely well over the years with data and AI focused investments. A lot of my more recent track record from 2016, 2017 onwards is data and AI. B2B businesses, some B2C, but mostly B2B. And because I had significant hands-on experience being part of the data mafia, if you will, in the US, is doing data deals, spinning up and investing and integrating data companies. And as a derivative of that, AI, where we build significant AI inside Life360 to do things like crash detection and response with a lot of data, honestly. Me and my team were just very, very well positioned when this whole ChatGPT thing broke out in 2022. Obviously, this is a new kind of AI. It kind of leapfrogs the AI that we had before, the sort of NLP and machine learning and computer vision that was dominant in the 2010 to 2022 era. So generative AI accelerates all that and provides many new capabilities. But we had a very good understanding of AI and data and generative AI when it came out. So and it was actually happening at the same time I was leaving Life360, and I just saw an opportunity of a lifetime. I was like, wow, there's going to be trillions of dollars of value that are going to be created with these generative AI tools. I got to just jump in, leave my cushy job at Life360 as a C-level, where you can imagine how much money I was making. Obviously, it was a lot. And with a fast-growing company that's doing well, I just have to leave that comfort zone and go all in on backing this next generation of AI companies, because I truly believe that's the right thing to do, and that's what we're doing today very successfully.
Yeah, you caught the mobile wave, and now you're diving into the AI. And when you look at companies that you're seeing tons of companies come across your desk, countless founders pitching you, asking you to get involved. Like, what kind of trends are you seeing? Like, what's the shiny object that everyone's kind of looking at right now, and what's kind of fading away? Because I'm seeing things just kind of turn over very quickly in terms of what's hot and then not hot.
Yeah, the velocity is insane, and the groupthink and piling on deals is even more insane in AI specifically. So this is very interesting times to be in. So I'll just say a couple of things here that I'm seeing in the market, which some could be obvious to some of our listeners, some might not. I've been saying it for 2 years, so some things have really turned out that way. So the first thing is we've had a massive wave of investment in infrastructure, LLMs, and sort of the the stack required to build and deploy LLM-based solutions. I would say we've overinvested in that space. And this is all the way from like NVIDIA market cap to Google spending, I don't know, $100 billion a year on like chipsets and on chips, right? And so on and so forth. And even at the LLM level, like for me, LLMs they're getting commoditized. Like, I don't think there is a big difference here now between like an OpenAI, GPT 405, whatever, and a Claude. I mean, obviously there's like details around this LLM does that better. But at the end of the day, it's getting commoditized, right? And really where the value is at the application layer. It's the last mile. It's the workflow, it's the use cases, it's the value that you actually bring to end users and consumers, right? And I think up until a year ago, the venture community has completely missed that. They were just like piling on like OpenAI rounds. And surprisingly, the application layer, which every research that goes in depth would show that that's where the majority of value creation is going to happen, was kind of looked at more like SaaS companies, right? And I don't think that's the case. I think what's going to happen at the application layer is that it's going to rewrite SaaS, which is, $1 trillion plus business in many ways. And it's going to create all those completely new use cases that we haven't even thought about. And it's all going to happen in the next 5 to 10 years. And it's going to build on top of the infrastructure that we overspent on, exactly like what happened in 1999 and 2000s, where we're like overspending on infrastructure for networking and the web. And then it took another 5 to 10 years more for Webvan to actually show up in the form of Instacart, right? So I think we're going to see something very similar, but condensed in timelines. It's not going to take 15 years; it's going to take 5, right? So I've been focused on investing only at the application layer since I started this fund in 2022, in both consumer and B2B, but more with an eye to B2B. So that's the first thing. The second thing is we've gone through this evolution of like, oh wow, free wrappers are never gonna work, to like, okay, here's all the ways that we can win, even though we're a wrapper, to like, oh gosh, free wrappers are actually great as long as you can grow fast enough. And I think that's another big mistake that's happening now in the market, where VCs are just flocking to whoever has like crazy month over month or quarter over quarter growth in revenue, but they're not looking at the moat. They're not focused on defendability. They're not focused on understanding what happens when the 10 incumbents see this thing when it's like $50 million of revenue and they want a piece, and the 100 other startups that are going to get funded when they're like, oh, I want to get this business, right? I want to go after this business and I'll take market share. And I think VCs are kind of turning a blind eye. They're not thinking about the commoditization and what lack of moat means. If you don't have moat or defendability, you're not going to create a multi-billion-dollar business. Just that's what history teaches us. So that's why at Recursive Ventures, we're very, very focused on our thesis of AI moat, which is really about what are the key differences in this business that, so the key question I ask CEOs is like, okay, you're ahead now. Explain to me exactly why you're going to be ahead 5 years from now. Right? So moat is key, and a lot of VCs ignore that.
Founders ignore it too. Founders don't pay attention enough to it.
Well, you got to find the right balance, because as a founder, on one end, yes, you have to grow, because if you don't grow, you're clearly, dead in the water. But at the same time, you also have to think about the long term. And that long term is you have to invest in actively creating a moat, or you're going to get disrupted by the 100 other startups that are just going to copy what you did overnight with vibe coding. And that's pretty dangerous.
Let me ask this question. Like, if you are a founder and you have the choice to invest in, trying to hit that month over month growth metric, or maybe not grow as fast, but have a more defendable moat that then, hypothetically you put more money into and it'll be, better. Like, do you want to see the companies making the month over month growth metric like the sexiest thing, and then they'll get the money and then they'll figure out the moat? Or do you think it's better for them to maybe not be explosive, 100% month over month growth, but have a defendable moat at that earlier stage, and that kind of like, call it pre-Series A?
the advice I typically give founders is to prioritize hitting their month-over-month growth metrics first, because I think if that's almost like a prerequisite. If you can't show that, you are. I mean, look, at early stage startups, there are only two things that matter: getting to product market fit and having enough capital to get to product market fit. Surviving until you get the product market fit. If you can't do the latter, which is getting capital, you're just gonna die, right? When you don't have money in the bank, you're just gonna, like, the company's gonna die. So I think you do have to hit your growth metrics or some, or get at least close to that. But then the trick is, how do you use that momentum, that velocity, to invest in your moat? And what happens with a lot of teams that I'm seeing, especially younger founders these days, is just they hit the growth metrics and they're just like cheering and they're excited and they lose sight of the moat. And then the music stops. Because the thing with not having a definibility or moat is, I don't know when the music stops. It could stop at the beginning. It could stop after you go public. But it will stop at some point because you don't have a moat. So it's kind of short-term thinking versus long-term thinking. You got to meet the short-term metrics and criteria that be a fundable business. But then you have to really think about how you allocate time and resources to invest in the long term.
What do you want founders to know about Recursive?
That when you hit up Recursive, you're going to get me. You're not going to get some associate. I'm going to be there for you, supporting your business. Me and my two partners, they're more on the support side. And you're going to get serial entrepreneurs who have taken companies from nothing to public, have been in your shoes, have raised every single round. That's the first thing. And the second thing is, we do one thing at Recursive Ventures, and we do it extremely well. We've done it for over 50 companies. We help you get your Series A done, your seed and Series A. That's our superpower. We get you funded. We know how to build the right narrative. We know how to figure out what the right KPIs are. We will make the most intros to the best VCs you will ever get from anybody on your cap table. That's our promise. We will get you funded. And at the same time, we're going to get out of the way where we're not needed. It's up to you to figure out what the business is. It's up to you to figure out what the product market fit is. We're not going to be able to do that for you because we're not in your shoes. It's your business. You run it. You know best. You know your industry best. But with us, we're going to give you as much funding as you need to really, realize your dream. Probably better than most other pre-seed funds you're going to talk with.
But how do they get your attention?
Yeah, that always comes up.
You said it's like the dream VC I always want, but how do I get the right to make you actually want to look at my whatever I'm building? So
between me, Konstantin Ottmer, who's one of my venture partners, and Chris Holz, who's another venture partner, we have backed over 300, I dare to say over 400 companies over the last 20 years. 400 companies. The best way to get to us is to get an introduction from a founder that we backed before, who knows you and knows us and can vouch for you. That's by far the best way. That's one that, we get 3 to 5 of these a day, but those are the deals that we jump on heads on and dig in and try to find ways to be helpful. Second best is to get a warm introduction for somebody who knows you or knows us not as well, but are still like, hey, this is a great person. I met them. Maybe I overlap with them a little bit. I think they're great. You should talk to them. That's also great. Cold calling doesn't work, guys. So just like.
And when it comes to, I'm always curious with kind of pre-seeds. Do you do seed or only pre-seed?
We mostly lead pre-seed rounds, but we also participate in seed rounds.
When it comes to price, how important is price for you coming into the round?
It's important, but we put it in the right perspective. I'll give you an example. 2/3 of our deals in Recursive Ventures are with successful repeat serial entrepreneurs. And we believe that experienced repeat entrepreneurs de-risk the business by 2 to 3x. I have some data backing this, but honestly, it's more of a theory. It's anecdotal, right? That's also what we see in our portfolio. So if we come across a successful repeat entrepreneur and they demand a higher valuation, or the market lends them that higher valuation, which happens. There's competition out there. Yeah, we would pay up because again, our math adds up to like, okay, 2x the valuation, 3x the de-risk. That's a good deal, right? So we're less valuation sensitive than other firms, right? If it's really the appropriate setting, right? If that's not the case, and we are making a bet on a less experienced team, or there's a lot of hands-on work that we have to do, then we kind of want to make sure that valuation really fits our model, where we can see 100+X return if this one works out. So that's where you see lower valuations. And I get this often, like how frosty, like how crazy is the market on valuations these days. I'd say it's pretty crazy, but it's not that different from 2020, 2021. Like back then, the valuations were also off the charts.
Well, and they were spread across a lot worse companies. I think the valuations that we're seeing are at least higher quality and fewer companies, but still high valuations. At least kind of my take.
Yeah, it's definitely we're definitely in the have and have not sort of era in AI. If you're a hot team coming up with OpenAI and you've got like a great story to tell, the valuations are going to be insane. And if you're just another team that's building a thin wrapper in legal or whatnot, you're likely to even get funded at this point. So there's really the have and have nots, but there's a lot of great founders and companies in the middle, which again, we think the valuations are reasonable. Like I think in Q2, we looked at the average entry valuation for us. It was, and most of our deals are Bay Area deals, so Silicon Valley, it is more expensive. Great people are probably in the $12.5, $13 million post-money range at the entry point. It's not low, but it still fits our model, and we can still get 100+X outcome with that kind of entry price point.
No, it's not too bad. Well, Itamar, this has been a phenomenal conversation from buying your kind of position into a company at kind of stage 0, stage 1, and then taking it all the way to public, and then now backing some of the best founders in AI. For founders that just want to learn more about you, your portfolio, where should they go?
LinkedIn. Follow me on LinkedIn. I write daily, and I write about VC board, and I write about startup anti-patterns. Both are very helpful for founders who are starting VC-backed companies. Just follow me on LinkedIn.
Beautiful. We'll make sure to leave that in the link below. And thank you for coming on the show. Really appreciate the time that we had today.
Thanks, Jason. It was great. And thanks for all our listeners.
If you were inspired by today's episode, then go ahead, watch this next episode. Promise it's worth it. And if you really enjoyed this last episode and you want to connect with the guest I had on today, make sure to leave a comment down below telling me why you would like an intro to this guest, and I'll make it happen.